Hey everyone and welcome. We all put a lot of trust in banks, right? We hand over our money assuming it's safe. But what's really protecting it? It's not just about the big vaults and security guards. Today, we're going to pull back the curtain on the invisible systems that keep a bank safe from the inside out.
Really think about it. What's to stop a single typo, a small system glitch, from snowballing into a huge financial mess? It's a simple question, but the answer is fascinatingly complex, and that's exactly what we're going to unpack. It all comes down to this one big idea: operational risk. Now, I know it sounds a little corporate and stuffy, but it's actually pretty simple. It's just the risk that things will go wrong in the everyday running of the bank. We're talking about anything from an employee hitting the wrong key to a massive system crash. And the potential causes are literally everywhere. You've got human error, a simple slip of the finger. Flaws in processes, like how payments get handled. Systems going down. Think about your ATM not working. And then there's the big stuff, like natural disasters or even fraud and phishing attacks. These aren't just theoretical worries. They are real daily vulnerabilities that banks have to be on top of 24/7. So, how on earth do they manage all that? Well, the first line of defense is something you can think of as the bank's annual health check. It's all about being proactive, about finding and fixing tiny cracks before they can ever become giant holes. The official name for it is a Risk and Control Self-Assessment, or RCSA. And the most important word in that whole phrase is self. It means every department has to kind of look in the mirror and ask the tough questions. What could possibly go wrong in our little world here? And are our safety nets actually strong enough to catch it if it does? And let me tell you, this is no quick checkup. It's this incredibly thorough cycle. First, they prepare and gather all the data. Then they hold workshops where teams literally sit around and brainstorm all the ways things could fail. After that, everything gets documented and reviewed by the higher-ups. From there, they create action plans to fix the weak spots, and then they monitor everything constantly. And the best part? It's not a one-and-done thing. They repeat this whole process every single year. But look, an annual checkup is great, but it's not enough on its own. Banks also need a way to monitor their health in real time. They need an early warning system that screams, hey, something's looking a little off over here. And that's where the next tool in their toolkit comes in. We're talking about key risk indicators, or KRIs, and honestly, the best way to think about them is as the bank's vital signs. Just like high blood pressure or a weird ECG reading can alert a doctor to a health problem before it turns into a crisis, these KRIs give the bank a heads up that a particular risk might be on the rise. And these indicators are super practical, down-to-earth things. For example, they'll track the number of times a cash drawer is off at a branch, or they'll watch for a sudden jump in failed login attempts on the banking app, or maybe a big increase in customer complaints about ATMs not working. See? These aren't just random numbers on a spreadsheet. They're signals, telling a story about the bank's operational health in that exact moment.
Of course, let's be realistic. Even with the absolute best systems in place, things will sometimes go wrong. It's inevitable. But a truly healthy system isn't one that never fails. No, it's one that learns from every single mistake.
This is where loss data comes into play. You can think of this as the bank's detailed medical history. Every time there's a hiccup, no matter how big or small, it gets recorded. What happened, why it happened, and what the fallout was, financially or otherwise. It becomes this massive library of past failures.
So here's how it works. Imagine the bank suddenly notices a huge spike in failed online transfers. That incident, along with its cause and the cost, is immediately logged as a piece of loss data.
And here's the magic. That piece of data acts as a powerful reality check. The next time the team sits down for their annual health check, that RCSA, they can't just pretend everything's fine. They are forced to look at that real-world failure and ask themselves, okay, are our controls for the payment system really as good as we thought they were? It creates this perfect feedback loop, connecting past failures directly to future prevention. All right, theory is great, but let's see how this all works in the real world. We're going to walk through a case study to see how this entire system, the health check, the vital signs, the medical history, all come together to diagnose and cure a real problem. So during one of those annual RCSA health checks, a bank uncovered a really persistent problem. In dozens of branches, loan officers were making mistakes when assessing an applicant's income, which was leading to bad loans being approved. So they put together a three-part fix. First, a new mandatory checklist. Second, better training for the staff. And third, a system update that basically forced them to do the proper checks.
Now check out the results. By fixing the root cause of that risk, they didn't just make the process safer, they actually made it 22% faster.
Turns out, with clearer rules and guardrails, the loan officers could make decisions with more confidence and speed. It's a classic case where better controls actually led to better efficiency. Just a fantastic side effect.
And this is the number that makes everyone's jaws drop. The changes they made directly prevented over 1 crore rupees in potential losses. Every single year. This wasn't just about tweaking a process. This was a massive financial victory that came directly from that proactive internal health check.
So what's the big takeaway here? By using all these tools together, the bank didn't just patch up a single problem. No, they spotted a systemic issue early on, they beefed up their defenses, they saved a ton of money, their audit ratings went up, and maybe, most importantly, they built a stronger, smarter risk culture for the long haul.
And that brings everything full circle, right back to you. All these internal processes, the health checks, the vital signs, the loss data, they might sound complicated, but they all have one very simple purpose: to make sure the bank is fundamentally healthy and stable, so that you can trust it with your hard-earned money.
So these systems are amazing for managing the risks a bank can see coming, the things they've learned from past experience. But that leaves us with one last, huge question, doesn't it? What about the risks they've never seen before? How does a bank possibly prepare for a true catastrophic black swan event? Well, that's a story for another day. Thanks for tuning in.